Imagine having $1 million in your bank account by the time you're 40. Sounds impossible, right? But it's not. If you start financial planning in your 20s, when you're in your 20s, time is on your side. It's a powerful ally, especially when it comes to compound interest. That's the concept of your money making more money. The sooner you start, the more time your money has to grow. Even modest savings can snowball into substantial sums over time. Think of it like planting a tree. The earlier you plant the seed, the more time it has to grow, branch out, and bear fruit. Each dollar you save is a seed, and with time, it grows into a money tree. The beauty of compound interest is that it works while you sleep. It's your money working for you instead of you working for your money. It's the key to financial independence. Get a head start on your financial future. The earlier, the better. Money doesn't manage itself. You need to take control. It's time we talk about efficient budgeting. A simple yet effective model to follow is the 50-30-20 rule. This means that 50% of your income goes towards essentials like housing and groceries. Then 30% is allocated for wants. This could be anything from a new pair of shoes to a weekend getaway. It's important to remember though that wants are not necessities, so don't go overboard. Last but not least, 20% is set aside for savings and investments. This is your future nest egg, your security blanket for when times get tough, or for when you want to make a significant purchase like a home. Living below your means doesn't mean skimping on happiness or enjoyment. It's about prioritizing your spending and saving wisely. So, a budget isn't about limiting yourself, it's about making your money work effectively. Life is unpredictable, an emergency fund is your financial safety net. Picture this. You're cruising along nicely with your financial plans, and out of nowhere, life throws a curveball. A sudden job loss, a medical emergency, or unexpected major expenses can turn your world upside down. In these situations, an emergency fund isn't just a nice-to-have, it becomes a lifeline. It's a personal financial buffer that can cover your bills and keep you afloat when the unexpected occurs. It's your shield against the unpredictability of life. So, how much should you aim for? A good rule of thumb is to have an emergency fund that covers at least 3 to 6 months of your living expenses. This gives you ample breathing space to navigate through financial storms without going into debt. Life doesn't care about your financial plans, but with an emergency fund, you have a safety net that keeps you prepared for whatever life throws your way. An emergency fund isn't optional, it's a must-have. Investments are the seeds for your future financial garden. Navigating the financial landscape can seem like a daunting task, but understanding your investment options can help you make informed decisions. Let's dive into some of the most common investment options available to beginners. First up, we have stocks. When you buy a stock, you're essentially buying a small piece of a company. You profit when the company does well and its stock price increases. While stocks can provide high returns, they also come with a degree of risk. Next, we have bonds. Unlike stocks, when you invest in bonds, you're lending money to a company or government entity. In return, they promise to pay you back with interest. Bonds are generally considered less risky than stocks. Mutual funds are another great option. These are essentially baskets of different stocks, bonds, or other assets. By investing in a mutual fund, you're diversifying your investment across a range of companies or industries, which can help manage risk. Exchange-traded funds, or ETFs, are similar to mutual funds but can be bought and sold throughout the day like stocks. They offer the flexibility of stocks with the diversification benefits of mutual funds. Now you may be wondering, why not just put all your money in one place? Well, that's where the concept of diversification comes in. Diversification is like not putting all your eggs in one basket. By spreading your investments across different types of assets, you can reduce the risk of a single investment's poor performance, significantly impacting your overall portfolio. Remember, each investment option comes with its own set of risks and rewards. It's essential to research and understand these before diving in. Consider your financial goals, risk tolerance, and investment horizon when choosing where to put your money. Investing may seem complicated at first, but with a little knowledge and a lot of patience, it can be a powerful tool for building wealth. Invest smart, diversify, and watch your wealth grow. Knowledge is power, and in the financial world, it's money. Let's take a moment to think about this. It's not just about earning more, but also about understanding how money works. How it grows, how it moves, and how it can work for you. Financial education is a journey, not a destination. It's a lifelong process that starts with reading books. Books on finance, investing, and wealth creation can open up new perspectives, teaching you strategies used by the most successful investors. Next, Consider taking courses. There's an array of online platforms offering financial literacy courses, from understanding the basics of budgeting to complex investment strategies. And don't forget about seminars. They're a great way to learn from industry experts and often offer the chance to network with like-minded individuals. Remember, in an ever-changing financial landscape, staying updated is key. It's about making informed decisions that align with your financial goals. So stay informed, stay ahead. Debt can be like quicksand, especially high-interest debt. It's a burden that grows exponentially, and before you know it, you're knee-deep and struggling to get out. The worst offender? Credit cards. Their convenience is a double-edged sword, enticing you to spend while silently accruing high interest. So, how can we avoid this pitfall? First, limit your use of credit cards. Use them sparingly and only when you can pay off the balance in full each month. Second, prioritize paying off any high-interest debt you already have. The longer it lingers, the more it will cost you. But not all debt is created equal. There's good debt and bad debt. Good debt, like a mortgage or a student loan, can help build your financial future. Bad debt, on the other hand, like credit card debt, doesn't add value and can quickly spiral out of control. Control your debt, don't let it control you. You are your most valuable asset. This is a truth we often overlook. While you're busy investing in stocks, bonds, and mutual funds, don't forget to invest in the most promising venture of all, yourself. The investment in personal and professional development, be it education, health, or skills, is not just an expenditure, it's a capital allocation that can yield significant returns. By honing your skills, acquiring new knowledge, or improving your health, you're not just enhancing your life quality, but also increasing your earning potential. Consider education. It might seem like a hefty upfront cost, but it equips you with the tools to navigate the financial world with confidence. Similarly, maintaining good health can save you from hefty medical bills in the future. In essence, every dollar spent on self-improvement is a step towards financial independence. Remember, no investment will ever pay off as much as investing in yourself. Invest in yourself, it pays the best interest. A goal without a plan is just a wish, especially in finances. Now let's talk about setting long-term financial goals. You see, it's not just about saving and investing, it's about having a clear vision of what you want to achieve with your money. Maybe you dream of starting your own business, or perhaps you envision a cozy house in the suburbs. Whatever your ambitions may be, it's crucial to set these goals early and start planning for them. Let's take starting a business as an example. It's not just about having a fantastic idea. You need to have the finances to back it up. You'll need capital to get started, money to keep the business running, and a buffer for any unforeseen expenses. So, how do you plan for this? You start by setting aside a portion of your income specifically for this goal. You invest it wisely, allowing it to grow over time. Now, this doesn't mean you should pour all your money into one goal. Diversification is key. You could also be setting aside money for a down payment on a house or for a dream vacation. The point is, each of your financial goals should have its own plan and its own dedicated pool of funds. But setting goals and making plans isn't enough. You need to be consistent and disciplined. It's easy to be tempted to dip into these funds for immediate gratification, but remember, these are for your future. Stay the course and keep your eyes on the prize. And don't forget, these goals can and should evolve over time. As you grow and your circumstances change, so too will your financial goals. Maybe you'll decide to go back to school, or maybe you'll want to invest in real estate. The key is to keep setting new goals and keep planning how to achieve them. So start today. Set your long-term financial goals, make a plan, and then start working towards it, step by step. Because remember, your financial future isn't just about what you earn, it's about what you plan to do with what you earn. Set your goals high and don't stop till you get there. You're now equipped with the knowledge to start your journey towards financial independence. We've delved into the importance of starting early, efficient budgeting, creating an emergency fund, making early investments, and the continuous pursuit of financial education. We've touched on sidestepping high-interest debt, investing in yourself, and setting long-term financial goals. Now it's your turn to make these concepts work for you. If you found this video helpful, subscribe and like the video. Remember, your financial future starts today, so make it count.